Over the past year, I have covered a wide range of ETFs from dividend strategies to growth strategies, highlighting those with strong potential to outperform in a changing market environment, while also issuing key warnings when certain funds show signs of weakness. But alongside that warning, I also highlighted several overlooked ETFs, funds which I believed had the potential to dramatically outperform. And as always, it comes down to how the ETF is built, its stock selection, sector exposure, and the strategy behind the structure. This ETF has quietly become one of the top performing dividend ETFs over the past 5 years. And what makes it even more compelling is that it offers similar and in some cases even better downside protection than SCHD while still maintaining a dividend yield over 3%. Even in today's volatile market with recession worries building and unemployment ticking higher, this ETF has consistently dampened volatility, capturing 40% of the downside of the S&P 500, less than half of the downside of the QQQ, and outperforming many of its peers like SCHD. And this brings me to FDVV, which is the Fidelity High Dividend ETF. I first issued a buy rating on this ETF over 8 months ago, and after the market pulled back and bottomed in April, I reiterated that rating with even greater conviction. And since then, it has outperformed SCHD by almost 10%. And for dividend investors, that level of outperformance can be extremely beneficial in the long term. This ETF is very unique, and in my opinion, it can provide investors with fantastic exposure to the markets and future growth while still minimizing overall volatility. FDVV has been performing exceptionally well over the past few years and has been able to outperform its peers, returning almost 60% in the last 3 years as opposed to SCHD's 16%, and returning 120% as opposed to SCHD's 50% over the last 5 years. And it has done this all while still providing a very strong dividend yield of over 3% and extremely strong risk mitigation. In the bear market of 2022, FDVV managed to significantly outperform the S&P 500, losing only 5%, which is in line with SCHD's performance, and that is absolutely amazing. But on top of that, the recent sell-off in February also showcased the fund's ability to minimize risk relative to the overall market. The rate of asset growth of the ETF in the last 3 years has been more than all of its peers, and nearly doubling from the time I first reviewed it. And its rising popularity is all due to its unique screening tactics, providing a combination of strong growth, strong risk mitigation, and of course, its strong dividend yield. And its 5-star Morningstar rating is definitely adding to its reputation, while SCHD has actually lost its 5-star rating and is now down to 3. So, how does this ETF work, and why is it positioned to outperform in the coming months? Now, if you want access to the same comparison tools, charts, ETF screeners, and ETF deep dives that I use in all of my videos, then I highly suggest to sign up with Seeking Alpha. And right now they are running their Black Friday sale with 20% off site-wide. That includes $60 off their annual premium plan, plus savings of over $220 on their Premium and Alpha Picks bundle, and $480 off their Pro Quant portfolio. You can use my link in the comments section or description down below, and once again, you get 20% off site-wide on Seeking Alpha. To begin, FDVV was established in September of 2016, so it has almost a decade of historical performance for investors to analyze. And currently, it has $6 billion of assets under management. And with an expense ratio of 0.15%, it is slightly more expensive than other passive dividend ETFs like SCHD, but it is still very cheap, making it a great long-term ETF. When you look at the fund's holding breakdown, this is where the unique attributes of the ETF come to light. You see a healthy mix of different sectors, with technology at the top at around 25%, with financials making up nearly 20%, and the rest with a relatively even allocation between consumer defensives, real estate, energy, and utilities. And what's unique about this is the fact that the allocation towards real estate, energy, utilities, and consumer defensives, while holding a significant portion in technology, is giving the ETF the ability to capitalize on upward movement within the tech sector while still providing a very strong dividend yield. The real estate sector and utilities especially tend to have very high dividend yields, and over 20% of the entire fund is allocated towards these 3 sectors. But on top of that, the utility sector and consumer defensive sector are known for their powerful risk management capabilities, and that is why the fund has also been able to provide very strong performance during market downturns. Again, you can see that just by looking at its performance during the 2022 bear market. but it is here where the fund has an edge over many of its peers, and I'll explain it in just a second. Now, when you look at the fund's top 10 holdings, you see 3 of the biggest technology stocks, Apple, Microsoft, and Nvidia at the top, making up 14% of the entire portfolio. These 3 companies have become core holdings in many other dividend ETFs as well, all except for SCHD, but it's mainly because of one reason, and that is their dividend growth. This is why FDVV has been gaining a lot of attention, and is also likely why it has been able to appreciate much better than its peers, capturing the same upward momentum as the S&P 500. So the big question is, how does the ETF work? I mean, what stock picking criteria allows you to have exposure to these 3 giant tech stocks along with real estate and utilities and still provide an almost 3% yield? The ETF uses 3 screening tactics, and those are dividend yield, dividend payout ratio, and dividend growth. And the significance of each criteria heavily impacts the overall holdings. That is what the weight number represents. So clearly the ETF puts a major emphasis on dividend yield. That is why it has a 70% weight. Now, FDVV uses trailing dividend yield over the last 12 months. And what this means is simply it takes assets with the highest dividend yield over the last 12 months. And this naturally includes assets like REITs and utilities because they tend to have the highest dividend yields. And utilities, as well as consumer defensives, are known for paying very consistent and relatively high dividend yields with great risk management, making it one of the main sectors investors shift towards during heightened volatility. In fact, utilities and consumer defensives have historically shown some of the strongest resilience during recessions. Consumer staples have averaged positive 1% returns in 6 of the last 7 recessions, while utilities have averaged around negative 2%, which is still far more stable than the broader market during downturns. Some investors may prefer allocating directly into sector ETFs like XLU for utilities or XLP for consumer staples, and those can absolutely be effective. But FDVV provides a more strategic, blended approach, giving you exposure to those defensive sectors while still maintaining a broader, quality-focused dividend strategy. Now, this isn't the only ETF. In fact, there are ETFs that provide even superior risk management during times of volatility with strategic active management and fixed income exposure. And I've actually covered all of these ETFs on my Substack, along with daily market insights, buy and sell ratings, and in-depth technical analysis. So come join me there, and you can ask me questions directly as well. Now, before we continue, I wanted to let you guys know that I just released a free dividend ETF cheat sheet that breaks down the 7 key metrics every smart investor should know, plus my #1 way to spot a dividend trap. You can grab your free cheat sheet by clicking the link in the description or comment section below. Moving on, the next criteria are the trailing dividend payout over the last 12 months and the trailing dividend growth over the last 12 months. Now, payout ratio is simply the amount of dividends distributed relative to earnings. Certain companies may distribute 50 to 75% of their earnings as dividends, or even more. FDVV is screening for high payout ratios, but it avoids stocks within the top 5% of highest payout ratios. This helps avoid stocks that only boast a high dividend yield, but have very poor long-term performance. Now, dividend growth is something I've discussed a lot, and it is a crucial aspect of dividend investing. But what's extremely unique here is that the fund doesn't screen for 5 years of historical dividend growth like other well-known ETFs such as SCHD or DGRO. It only looks at the past 12 months. And this criteria allows the ETF to include companies that are showing growing strengths in their ability to generate strong cash flow, resulting in strong dividend growth. There are many companies that exhibit very healthy financials and strong earnings growth, but have just recently started distributing a dividend. And the amount of dividends they provide may not be that much. And big name technology stocks fall under this category, such as Apple, Nvidia, and Microsoft. So this criteria allows the ETF to invest in many strong growth opportunities alongside strong dividend stocks, providing a very interesting balance. And in my opinion, this makes it a very strong ETF, especially considering that many other big name tech stocks have started to distribute dividends. So they could soon be included in this ETF as well. Now, of course, there are some risks to owning big name tech stocks, but because the ETF combines it with strong risk mitigating sectors and a strong dividend yield, you're getting risk averse exposure to big tech. That is why when you look at the ETF's total performance side by side with SCHD, it has been able to crush it. But when you look at the bear market of 2022, the ETF provided the same level of downside risk mitigation. Now, The video wouldn't be complete if we didn't talk about some of the downsides of the ETF as well. And the biggest one I can think of is its dividend growth criteria, because only considering the trailing 12-month dividend growth does not showcase consistency in the long term. Companies that have a history of strong dividend growth from 3 to 5 years are more likely to continue to provide dividend growth in the future. And that is why when you look at the fund's dividend scorecard on Seeking Alpha, it has not been able to provide consistent dividend growth over many years, but funds like SCHD have been able to do so. So, in my opinion, for dividend investors, the lack of historical growth may be affecting the attractiveness of the ETF. But overall, FDVV has proven to be a fantastic ETF, and it can continue to outperform given the current market environment. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit that thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one. Bye! This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations.